Hi there! In this video, we'll explain how SDLT applies to granny annexes after multiple dwellings relief ended and what buyers should consider.
Welcome to another explainer. I'm your host and UK tax expert representing my tax accountant. Today, we're unpacking a massive and, frankly, incredibly consequential shift in stamp duty land tax. If you're a UK taxpayer, a property investor, or maybe just a family dreaming of a multi-generational home with a bit of extra space, the ground beneath you has literally just shifted. You really need to pay close attention to this, because right now, understanding the nuances of this specific legislation is the absolute difference between a smooth property purchase and an absolute financial nightmare.
Picture this scenario for a second. You've worked your absolute socks off, you've saved for years, and you are finally buying that dream multi-generational home. It's perfect, right? You've got a beautiful main house for you and the kids, and a lovely self-contained granny annex down in the garden so your elderly parents can maintain their independence while still being close by. You shake hands with the seller, you sign the papers, and you are entirely confident you've budgeted down to the very last penny. And then, completely out of the blue, HMRC hits you with a massive, unexpected tax bill. It threatens to derail the entire purchase and causes immense stress for your family. This is a huge problem that UK taxpayers commonly overlook, exactly how the taxman views that seemingly innocent granny annex.
Well, what if I told you that unexpected bill could easily be an extra £45,000 on a £900,000 home? Yes, you heard that correctly. Just having that extra bit of living space could trigger a punitive 5% tax surcharge applied to the entire purchase price of your property. This is a huge deal right now, today, because the rules have just changed dramatically, and they are catching countless buyers, property investors, and honestly, even some professional conveyancers completely off guard.
And that right there is exactly why we're doing this explainer today. At My Tax Accountant, or MTA for short, we act as your expert UK tax guides. We specialize in navigating these incredibly complex, ever-shifting UK tax laws to save you from making devastating but completely avoidable mistakes. Mistakes that, as we've just seen, could easily cost you tens of thousands of pounds.
Okay, let's dive right into this. Here's a quick roadmap for today's explainer. First up, the granny annex tax shock. Then, life after MDR abolition. Third, the subsidiary dwelling test. Fourth, we'll walk through a real-world taxpayer case study. Fifth, HMRC's strict dwelling rules. And finally, expert help and your next steps.
All right, Section 1, the granny annex tax shock. Recent UK budgets have totally flipped the script for families and investors looking into multi-generational living. Historically, buying a property with an annex offered a rather brilliant tax incentive, effectively lowering your overall bill. But that landscape, it's completely turned upside down now. What used to be a fantastic financial benefit has morphed into a massive, heavily scrutinized tax trap.
To understand how this trap works, let's move to Section 2, life after MDR abolition. For years, multiple dwellings relief, or MDR, was an absolute lifeline. It basically allowed buyers to calculate their stamp duty based on the average price of the dwellings, rather than the total combined cost. It was highly efficient, letting you benefit multiple times from lower tax bands. But because of some questionable claims, often pushed by aggressive reclaim firms who tried to argue that a standard bedroom with an ensuite was somehow a separate dwelling, the government felt the system was being abused. So they decided to pull the plug entirely.
Let's just look at how ridiculously fast this all unfolded. March 6, 2024 was your cutoff to exchange contracts and still qualify for the old MDR rules. By June 1, 2024, MDR was officially abolished for any new transactions. Done. Gone. But the real shocker? That arrived in the autumn budget. Effective from the 31st of October 2024, the Chancellor increased the higher rate surcharge on additional residential properties from 3% to 5%. So not only have you lost the relief, but the penalty for falling into this trap has jumped significantly overnight. So how do we actually survive this new landscape? This brings us to Section 3, the subsidiary dwelling test. Now listen, this is the critical piece of legislation that can quite literally save you tens of thousands of pounds. Since you can no longer claim MDR, your singular overriding goal is to avoid triggering that 5% additional property surcharge altogether. To do that, we first need to get inside the taxman's head. What exactly is a dwelling to HMRC? Well, a dwelling must be a truly self-contained living space. It needs its own independent access, its own distinct kitchen or kitchenette, a bathroom, and crucially, a high degree of privacy and security. Let me be very clear here. A large bedroom with an ensuite? That doesn't count. A converted garage with a bed but no cooking facilities? Doesn't count. But a fully equipped granny annex with its own front door? Oh, that absolutely counts as a second dwelling in the eyes of the taxman. And if that annex fails a very specific mathematical test, you are suddenly on the hook for the 5% surcharge on the entire property price. And this brilliantly illustrates the maths you need to know. To dodge that 5% surcharge applying to your whole purchase, the annex must be legally deemed subsidiary to the main house. The numbers here are absolute. The main house must account for at least 2/3, so 66.6% of the total property value. Conversely, the annex's market value must sit strictly under 1/3, or 33.3% of the total purchase price. If the annex is just a bit too valuable, say it's a massive coach house making up 40% of the property's value, the subsidiary test fails, and those heavy taxes, they apply without exception.
Time for a quick professional tip. Listen, you absolutely must apportion the purchase price on a strict, just, and reasonable basis, ideally supported by a professional RICS surveyor's valuation. Do not just guess these numbers. And please, whatever you do, do not try to artificially manipulate them just to sneak under that 1/3 threshold. HMRC scrutinizes these value splits incredibly heavily. If they open an inquiry and find your apportionment isn't grounded in reality, the psychological stress of that tax investigation is massive, and the financial penalties, plus added interest, are severe.
Okay, let's make this abstract theory a bit more concrete with Section 4, a real-world taxpayer case study. Let's actually crunch the numbers in pounds sterling so you can see the sheer scale of the financial risk involved here.
Imagine this background situation. Our clients are buying a gorgeous countryside property for £900,000. They plan to live in the main house and have their elderly parents live in the fully self-contained garden annex. Now they do the smart thing, they get a professional surveyor in prior to completion. The surveyor apportions that $900,000 purchase price on a just and reasonable basis. They value the main house at $650,000 and the annex at $250,000. Looking at the maths, $250,000 is safely less than 1/3 of the total $900,000 price. Therefore, the annex successfully passes the subsidiary dwelling test.
So, let's look at the actual tax outcome of that split. Because they pass the subsidiary test, they pay standard residential SDLT rate, resulting in a total tax bill of £32,500. But what if that annex was just slightly larger? Say it was valued at £350,000, which means it fails the test. The 5% surcharge would suddenly apply not just to the annex, but to the entire £900,000 purchase. Their tax bill would literally skyrocket to £77,500. Let that sink in. That is a staggering £45,000 difference, completely dependent on the precise valuation and legal standing of that single annex. Passing this test literally saves you £45,000 in cold, hard cash.
Because the stakes are so incredibly high, here are the exact compliance steps every buyer must follow. Step 1, secure that professional valuation prior to completion. Step 2, ensure your conveyancer apportions the price justly on your tax return. Step 3, file the SDLT return within the strict 14-day deadline from the effective date of the transaction. And Step 4, retain physical evidence. We're talking photographs, floor plans, utility layouts, proving the annex has the necessary facilities to be a dwelling, but that it remains strictly subsidiary in its market value. Which leads us perfectly into a major pitfall in Section 5, HMRC's strict dwelling rules. Because what happens if HMRC decides to question the physical layout of your property? They look incredibly closely at what actually constitutes a separate dwelling.
Here's a crazy "did you know" for you. Ever heard of the Fander versus HMRC tax tribunal case? A taxpayer tried to claim a property had a separate dwelling to gain a tax advantage. But the annex was connected to the main house by a short open corridor, and crucially, there was no lockable door between them. Because there was free access, the tribunal ruled there was an insufficiency of privacy and security. The annex failed the separate dwelling test completely. Something as simple as a missing lockable door can literally unravel your entire tax plan in a tribunal.
Now, what's really interesting about this slide is that even though multiple dwellings relief is gone, HMRC uses this exact same case law to determine if a dwelling exists for the purposes of applying the 5% surcharge. They demand genuine, uncompromised independence. If a member of the general public couldn't comfortably and privately live in that annex because they share a boiler, share an entrance, or just lack a proper lock, HMRC will argue it is not a separate dwelling. You absolutely must view the property through their strict lens. Clearly, this is not an area for guesswork, and it's certainly not for DIY tax returns. Let's move to Section 6, Expert Help and Next Steps. Because honestly, you do not have to navigate these treacherous and highly complex UK tax waters alone.
So, the crucial point is this. Let's do a rapid-fire recap of your key takeaways. 1. MDR is officially abolished for new transactions. 2. The additional property surcharge has just been hiked up to 5%. 3. To avoid paying that 5% on your entire home, the annex value must be strictly under 33.3% of the total price. 4. The annex itself must be fully self-contained. And 5. You must abide by that strict 14-day SDLT filing deadline.
If you are in the process of buying a property with an annex, or you're planning to in the future, you need professional advice before you exchange contracts. Contact My Tax Accountant today. You can reach our experts by phone at 0208-570-8531. Shoot us an email at info@mytaxaccountant.co.uk, or just visit our website at www.mytaxaccountant.co.uk. And hey, if you found this explainer helpful, please hit subscribe on the MTA YouTube channel for more essential tax updates.
Finally, please note our disclaimer. This explainer is for general information only and is not intended to provide specific legal or tax advice. Please consult a qualified professional at MTA regarding your individual circumstances. I will leave you with this final, somewhat provocative thought. When a £45,000 tax penalty is hanging in the balance, resting entirely on the definition of a lockable door and a surveyor's maths, can you really afford to leave your family's financial future to chance? Thank you so much for joining me, and we'll see you in the next explainer.